Most people are opening their apps, glancing at the silver price, seeing numbers in the mid-60s, and assuming they understand what's happening. But the reality is that the price on your screen is now the least important part of the silver story. Because behind that number, a structural shift is unfolding in the global physical market that most investors and, frankly, most media outlets are not prepared to explain. Today is December 27, 2025. And over the past several weeks, a quiet but decisive change has taken place that marks a turning point for silver over the next 12 to 18 months. If you're holding physical silver today in the United States, Canada, the United Kingdom, or anywhere in the developed world, you are no longer just an investor waiting for price appreciation. You have effectively become a provider of liquidity in a market where real deliverable metal is becoming harder to source at scale. In this deep dive, we are going to move past surface-level headlines and walk through the underlying mechanics that explain why the global silver shortage has now gone mainstream, why the physical market is tightening even as paper markets appear orderly, and why a $100 silver price is no longer a speculative fantasy, but a mathematically defensible outcome based on supply constraints, industrial demand, and market structure. To understand how we reach this point, we have to begin with China. Because China is not just another participant in the silver market. It is the central node of the global refining and consumption network. China is the world's largest silver refiner, processing a substantial portion of the silver that ultimately feeds global electronics manufacturing, solar panel production, battery technology, and industrial components. For years, Western markets have benefited from China accessibility to export refined silver into global hubs such as London, Zurich, and New York, effectively smoothing out supply imbalances. That model is now changing. The reason has very little to do with geopolitics and everything to do with domestic demand. China's green energy transition has moved from policy ambition to physical reality, and that transition requires silver at a scale that exceeds China's domestic production capacity. Solar photovoltaic cells, electric vehicles, advanced power electronics, and grid infrastructure all require silver not as a decorative metal, but as a functional input with no viable substitute at current efficiency levels. As China accelerates solar deployment targets and expands electric vehicle production, the amount of silver required per unit of economic output has increased, not decreased, despite incremental efficiency gains. This creates a simple but powerful constraint. When domestic demand rises faster than supply, exports become optional rather than automatic. For Western investors, this is the critical insight because when China retains more refined silver internally, the immediate pressure does not show up on price charts first. It shows up in the London Bullion Market Association vault system. London functions as the clearing hub for much of the world's wholesale silver trade. And when export flows tighten, the LBMA is the first place where inventory stress becomes visible. What we are witnessing now is a subtle form of resource nationalism, not in the traditional sense of bans or embargoes, but in the prioritization of domestic industrial needs over global market smoothing. This is not a one-off decision. It is a structural pivot that aligns with China's long-term energy and manufacturing strategy. As this export dynamic shifts, the global silver market begins to behave differently. And this brings us to the macro decoupling that many investors have missed. Historically, silver has exhibited a strong correlation with energy prices, particularly crude oil, because mining, refining, and industrial demand all scale with energy costs. When energy rises, silver tends to follow, and when energy stabilizes or falls, silver traditionally cools off. That relationship is now breaking down. Over the past several months, silver has continued to rise even as crude oil prices have stabilized and in some cases softened. This divergence is not random, and it is not speculative froth. It is evidence of a re-rating process taking place in real time. Silver is increasingly being priced not merely as a precious metal or an inflation hedge, but as a strategic technology metal embedded in the global energy transition. This is a critical distinction because markets price strategic inputs differently than cyclical commodities. When a material becomes essential to long-term infrastructure and technology deployment, price behavior shifts from demand-sensitive to availability-sensitive. In other words, the question stops being, is demand strong, and becomes, is supply sufficient? This is the same transition we observed in lithium before its multi-year price revaluation, when demand growth overwhelmed supply elasticity and traditional valuation models failed to capture the speed of repricing. The silver to oil ratio, a long-term macro indicator that tracks relative value between silver and energy, has now broken levels that had held for nearly 4 decades. This is not a technical curiosity. It is a signal that the market is assigning silver a new role within the global commodity hierarchy. As this macro decoupling unfolds, it exposes a deeper vulnerability in the silver market that cannot be resolved through pricing alone. And that vulnerability lies in the paper versus physical structure of modern precious metals trading. The vast majority of silver traded daily does not involve the movement of physical metal. Instead, it exists as futures contracts, derivatives, and unallocated positions that settle in cash rather than delivery. Estimates vary, but it is widely acknowledged that for every ounce of physical silver available for delivery, there are hundreds of ounces represented in paper form. This structure functions smoothly as long as confidence remains intact, and most participants do not demand physical settlement. The problem arises when confidence shifts and when a meaningful percentage of participants attempt to convert paper exposure into physical ownership simultaneously. The math simply does not support that outcome. In such scenarios, markets rely on mechanisms such as cash settlement, delivery delays, or force majeure clauses to maintain order. What makes the current environment different is the geographic distribution of physical holders. A significant portion of physical silver ownership resides in developed economies where legal ownership rights and delivery expectations are taken seriously. If even a fraction of these holders decide to take delivery or move metal into private storage, the stress on exchange-linked inventories increases exponentially. This is not speculation. It is arithmetic. As inventory buffers thin, price becomes less effective as a rationing mechanism, because industrial demand is relatively price inelastic in the short term. Manufacturers cannot simply stop producing solar panels or power electronics because silver prices rise. They must secure supply, often at any cost. This is how shortages transition from theoretical to operational. The conversation then naturally shifts to price targets, not as predictions, but as reference points derived from market structure and historical context. The $67 level that silver recently crossed functioned as a psychological and technical barrier for years. It represented a zone where selling pressure historically emerged and where speculative narratives tended to break down. Now the level is transitioning from resistance to support. And this transition matters because markets tend to build new trading ranges above former ceilings. When we examine inflation-adjusted historical peaks, Fibonacci, retracement levels, and long-term commodity cycles, price zones around $75, $100, and even higher emerge not as extreme scenarios but as logical extensions if current conditions persist. A move toward $75 reflects normalization of supply stress. A move toward $100 reflects a failure of supply to respond quickly enough to sustained industrial demand. Importantly, this is not a get-rich-quick narrative. Silver remains volatile and price swings will continue. The core thesis here is not speculation, but preservation. In a world where currencies are being diluted, supply chains are being relocalized, and strategic materials are being prioritized domestically, holding physical silver represents participation in a real asset market that operates outside purely financial abstractions. As we approach 2026, the most important data point to monitor is not daily price action, but export flows and inventory levels. January export numbers, particularly from Asia, will offer confirmation of whether the tightening trend is accelerating or stabilizing. A sustained reduction of more than 15% in export volumes would materially shift the timeline for higher price targets. This is why the silver shortage going mainstream matters. It is no longer confined to niche forums or specialist reports. It is showing up in supply chains, dealer availability, and industrial procurement decisions. If you are watching this analysis, you are ahead of the curve. Not because you are predicting the future, but because you are understanding the present. And that understanding is what separates reactive investors from informed participants in a market that is quietly but decisively changing. As we move deeper into what this shortage means for 2026 and beyond, it becomes essential to understand how markets actually transition from awareness to repricing. Because shortages do not announce themselves with headlines, they emerge through constraints, delays, and quiet adjustments that only become obvious after the fact. The silver market today is in that transitional phase where participants are slowly realizing that the old assumptions no longer apply. One of the most important misconceptions to address is the idea that higher prices automatically solve supply problems. In many commodity markets, price increases incentivize new production, bring marginal supply online, and eventually restore balance. Silver does not operate that way, at least not in the time frame most investors expect. Silver is primarily produced as a byproduct of other mining operations, such as copper, lead, and zinc. This means that even dramatic increases in silver prices do not immediately result in a proportional increase in silver supply, because miners cannot simply turn on silver production independently. Decisions to expand mining operations are based on the economics of the primary metal, not silver itself. As a result, supply response is slow, capital-intensive, and subject to regulatory and environmental constraints that further delay new output. This structural rigidity is why silver shortages tend to persist longer than markets initially anticipate, and why price adjustments often overshoot before equilibrium is restored. When we map this reality onto the current environment, the implications become clearer. The physical silver market is tightening not because of speculative hoarding, but because demand from multiple sectors is converging at the same time. Industrial demand continues to grow as electrification accelerates globally. Investment demand remains resilient as investors seek tangible assets in an environment of monetary uncertainty. Meanwhile, available above-ground inventories are declining as metal moves from easily accessible vaults into long-term storage, industrial use, or sovereign reserves. This creates a cumulative effect, where each ounce removed from circulation has an outsized impact on marginal availability. Dealers experience this first, not through dramatic announcements, but through longer lead times, higher premiums, and reduced allocation sizes from wholesalers. These signals often precede major price moves because the wholesale market reacts before retail investors notice. As inventories tighten, paper markets attempt to maintain continuity through rollover mechanisms and cash settlement. But this only works as long as confidence remains intact. The moment confidence falters, price becomes a secondary concern to access. This is the environment in which force majeure clauses, delivery delays, and exchange rule adjustments become relevant, not because of malice or manipulation, but because the system is designed to prioritize stability over individual settlement preferences. Understanding this framework is critical for interpreting future price action because sharp upward moves are often the result of delayed repricing rather than sudden demand spikes. Looking ahead to the 2026 roadmap, it is helpful to frame potential price levels as zones rather than precise targets. The $75 level represents the first major normalization threshold, where silver prices reflect sustained supply tightness and elevated industrial demand without yet incorporating panic or extreme scarcity premiums. A move to this level would likely be accompanied by increased media attention, higher participation from generalist investors, and renewed interest from institutional players who previously viewed silver as a peripheral asset. The $100 level, by contrast, represents a regime shift. Prices at this level imply that the market has accepted a structural shortage as the new baseline rather than a temporary imbalance. At $100, silver is no longer priced as a marginal precious metal. It is priced as a strategic input whose availability constrains economic activity. This is the level at which substitution efforts intensify. Recycling becomes more economically viable, and governments begin to take a more active interest in securing supply chains. It is also the level at which volatility increases, because small changes in supply or demand can have outsized effects on price beyond $100. Levels such as $120 or higher are not forecasts, but stress scenarios that reflect compounded constraints and delayed supply responses. Whether these levels are reached depends not on enthusiasm, but on persistence. If export restrictions, domestic prioritization, and industrial demand remain intact through 2026, higher price regimes become increasingly plausible. It is important to emphasize, however, that none of this constitutes a guarantee of linear price appreciation. Silver remains one of the most volatile major commodities, and pullbacks are inevitable. Volatility does not negate the underlying thesis. It is a feature of a market transitioning between regimes. For participants, the distinction between speculation and strategy becomes critical. Chasing short-term price moves carries significant risk, while understanding the structural drivers allows for informed positioning aligned with long-term objectives. This is why framing silver as a wealth preservation asset rather than a speculative vehicle is essential. In an environment where currencies face ongoing debasement pressures, real assets with constrained supply offer a form of optionality that paper claims cannot replicate. Physical silver in particular occupies a unique position because it bridges monetary and industrial functions, making it resilient across multiple economic scenarios. As we approach key data releases in early 2026, attention should be focused on export statistics, inventory reports for major vaulting centers, and industrial procurement trends. These data points provide early warning signals that precede price adjustments. A sustained decline in export volumes, particularly from major refining hubs, would confirm that the tightening trend is not transitory. Similarly, continued drawdowns in exchange-registered inventories would indicate that physical demand is absorbing supply faster than replenishment can occur. These are measurable, observable metrics that allow market participants to assess risk without relying on sentiment or speculation. The broader implication of the global silver shortage going mainstream is that markets are relearning an old lesson. Not all assets are equally elastic, and not all supply chains can respond to price signals in real time. Silver's role in modern technology, combined with its constrained production profile, places it at the intersection of scarcity and necessity. That intersection is where repricing occurs often abruptly and with lasting consequences. For those watching this unfold, the goal is not to predict exact price levels, but to recognize that the framework governing silver has changed. When frameworks change, valuations follow. As we move forward, the most valuable asset is not foresight, but understanding. If you're tracking these developments, monitoring the data, and thinking in terms of structure rather than noise, you are positioning yourself not for hyper-driven gains, but for informed participation in a market that is redefining itself in real time. Keep an eye on the numbers, not the headlines. And remember that shortages are not announced, they are revealed through behavior. If you found this analysis helpful and grounded in real data rather than speculation, consider subscribing and enabling notifications. This channel is focused on market reality, not narratives. And if you are holding physical silver as part of a long-term strategy, comment reserve below. Not as a signal of belief, but as recognition that the rules of this market are no longer what they used to.